What is financial forecasting? Financial forecasting is a critical practice for businesses, investors, and analysts to predict future financial conditions and make informed decisions. To create a financial forecasting, you need to understand the basics. Some key components are revenue forecasting, expense forecasting, and profit forecasting. The second thing you should do is gathering data. For the third step, we have choosing a forecast method. There are two forecast methods, which include the qualitative method and the quantitative method. Fourth step is conducting a time series analysis. The fifth one would be validating the forecast, compare it with actual data, and calculate forecast accuracy. Sixth step would be adjusting and refining, incorporate new data and refine models. And the last and seventh step is to present the forecast. What are startup costs? These are the initial expenses required to start a business. These are one-time only payments. Some examples are legal fees, licenses and permits, equipment, and office space. The next type of cost we have is the variable one. These expenses are the ones that fluctuate with the level of production or sales. Some examples are cost of goods sold, sales commissions, raw materials, and shipping costs. Finally, we have fixed costs. These are expenses that remain constant regardless of the level of production or sales. Some examples for these costs are rent, salaries, utilities, and insurance. What are direct costs and indirect costs? The first one, they are expenses that can be directly attributed to the production of goods and services. Some common direct costs are raw materials, labor, manufacturing supplies, and direct equipment. On the other hand, indirect costs are expenses that cannot be directly linked to a specific product or service. Some examples of this are utilities, rent, administrative salaries, depreciation, and office supplies.
But why is it important for an enterprise to minimize costs? Well, for any business, large or small, controlling costs is a fundamental aspect of financial health. Lowering costs increase profitability. It also helps maintaining competitive pricing, improving customer satisfaction, and ensuring long-term sustainability. Some ways to minimize costs are operational efficiency, because streamlining operation is a great way to reduce costs. This involves evaluating and improving processes to eliminate waste. Another way to reduce costs is by integrating technology in every process. Investing in technology can lead to significant cost savings. Automatization of repetitive tasks, for instance, reduce labor costs and minimize human error. To sum up, minimizing costs is not just about cutting expenses, but about optimizing the way resources are used. Now, we are going to answer another very important question. How does a business make money? Let's break into it down step by step. First, let's start with the basics. A business makes money by providing goods or services in exchange for a payment. This payment is known as a revenue. The revenue is the lifeblood of any business. But how we ensure this revenue doesn't exceed our cost to generate profit? First, we are going to identify a market need, a problem that your business can address. Then, we develop a value proposition. This is the product that will address this need. You need to remember that you must have a value proposition in order to differentiate from your competitors. After identifying that, you should create a business model in order to have a way to generate revenue. This includes deciding on pricing strategies, sales processes, and revenue stream. Now, in order to have revenue, you must select an effective marketing strategy. But this leads to another problem. How to calculate revenue? There's a very easy formula. Total revenue equals the price per unit multiplied by the number of units sold. For example, if you sell 100 units of a product at 50 each, your total revenue will be 5,000.
Why is it important to maximize revenue? Maximizing revenue is vital for the sustainability and growth of any organization. Revenue serves as the lifeblood, fueling innovation, expansion, and competitiveness in the marketplace. It provides the resources necessary to invest in research and development, improve products and services, and attract top talent. Moreover, robust revenue streams offer stability, enabling companies to navigate economic uncertainties and fulfill communities of skateboarders. Beyond financial gain, maximizing revenue empowers businesses to make meaningful impact on society, driving progress and contributing to the well-being of communities. In essence, maximizing revenue isn't just about profit, it's about securing the foundation for long-term success and making a difference in the world. What is profit? Profit and loss are fundamental concepts in the world of businesses and finance. Profit refers to the financial gain earned when revenue exceeds expenses. It's a reward for a company's efforts, innovation, and efficiency. Profit allows businesses to reinvest in growth, reward stakeholders, and ensure sustainability. On the other hand, loss occurs when expenses exceed revenue, resulting in negative financial outcome. While losses may be discouraging, they provide valuable insights promoting businesses to reassess strategies and improve efficiency. Understanding profit and loss is crucial for effective financial management and decision making. It's about optimizing resources, mitigating risks, and achieving long-term success. In essence, profit and loss represent the heartbeat of every business, driving performance, resilience, and prosperity. The difference between gross and net profit. Gross profit and net profit are key metrics used to assess the financial health of a business. Gross profit represents the revenue earned minus the cost of goods sold. It's a measure of the probability of a company's core operations before accounting for other expenses. Essentially, it indicates how efficiently a company is producing and selling its products or services. On the other hand, net profit goes beyond gross profit by deducting all expenses, including operating expenses, taxes, interest, and overheads. Net profit provides a comprehensive picture of a company's profitability after accounting for all costs associated with its operations, while gross profit focuses solely on direct profitability. Net profit offers a more holistic view considering all expenses. Both metrics are crucial for evaluating a company's performance and making informed decisions about its future.
What is the break-even point? The break-even point is a fundamental concept that tells us the level of sales of a business needs to achieve in order to cover its costs without making a profit or a loss. Think of it as the financial sweet spot where your total revenue exactly matches your total expenses. Here's how it works. Fixed costs. These are costs that remain constant regardless of how much you produce or sell, such as rent, salaries, and insurance. Variable costs. These fluctuate with your production volume like materials and also labor directly tied to production. Sale price per unit. This is the amount of you charge your customers for each unit of your product. To find your break-even point, you divide your fixed costs by the contribution margin per unit, which is the sales price per unit minus the variable cost per unit. This gives you the number of units you need to sell to cover your costs. Reaching the break-even point means you are not losing money. but you're not making a profit either. It's the threshold beyond which your business starts generating profit. What is an income statement? An income statement, also known as profit and loss statement, is a financial document that provides a summary of a company's revenue, costs, and expenses over a specific period, typically a quarter of a year. Here's a simplified breakdown. Revenue: the total amount of money earned from selling goods or services. Cost of goods sold: direct costs attributed to the production of the goods sold. Gross profit: revenue minus cost of goods sold. It shows how much profit you're making from your core business operations before deducting other expenses. The gross profit is equal to revenues minus the cost of goods sold. Profit revenues is equal to revenues minus cost of goods sold. Then, operating expenses. These include the costs like salaries, rent, utilities, and marketing. Operating income. This includes gross profit minus operating expenses. It indicates the probability from regular business operations. Operating income equals gross profit minus operating expenses, and operating income equals gross profit minus operating expenses. Net income is the bottom line, which includes all the revenues and expenses, including taxes and interest. It represents the company's profit or loss. The net income equals the total revenue minus total expenses. The income is equal to the total revenue minus total expenses. The income statement is crucial for understanding the profitability of your business and making informed financial decisions. What is cash flow? Cash flow refers to the movement of money in and out of your business. It is essential for maintaining liquidity and ensuring that you can meet your financial obligations. And there are many types of cash flows. First one is the operating cash flow. This is the money generated from your core business activities like production or services. It reflects the cash available for running daily operations. The operating cash flow is equal to the net income plus non-cash expenses minus changes in working capital operating cash flow. And the cash flow is equal to the net income plus non-cash expenses minus changes in working capital. Investing in cash flow. This relates to the cash used or generated from investments in assets, such as purchasing equipment or selling investments. It indicates how much of your business is investing in future growth. And then we have financing cash flow. This involves the cash transactions related to the funding businesses, including issuing shares and borrowing money, and repaying debts, and it shows you how your business finances its operations and growth. Monitoring cash flow is vital because it helps you manage liquidity, avoid insolvency, and make strategic decisions about financing and investments. In conclusion, understanding these three concepts, the break-even point, income statement, and cash flow, empowers you to make informed decisions that can drive your business forward. The break-even point helps you gauge the financial sustainability. The income statement provides a snapshot of profitability, and cash flow ensures you have the liquidity to operate and grow.
Income statement and cash flow statement are together a collection of data that can help you improve your efficiency. Income statement is a financial statement that shows you the company, income, and expenditures. But that's not all. It also shows if a company is having positive or negative numbers for a specific period of time. This statement helps business owners take the decision of increase revenue, decrease costs, or both. It may also show how effective the actual strategy is for the business. This gives the possibility to change for a better one or keep in this one. While other financial statements make this study annually, this one is done every month. Because of this, investors can track the performance as if it was a stock exchange. It also highlights the future expenses which are incurred by the company. And the last advantage is that they give you an overall idea of your situation. Cash flow statement is other statement that provides information about operation activities. That includes all the money needed to work. Investing activities is all the money related with long-term inversion. Financial activities is the transaction between other businesses and the company. This study helps you know how your money is administrating and how to better administrate it. Ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statement, such as the balance sheet and income statement. The idea of this analysis is that it compares line item data from companies' financial statement to reveal insight regarding profitability, liquidity, efficiency, and solvency. It is used to know the health of the company. In other words, know how the company is performing and predict its possible performance in the future according to the current data. The net profit margin is a financial metric that shows the percentage of revenue that remains as profit after all expenses have been deducted. This provides an idea of the company's efficiency and profitability. The formula to calculate this is the next one. This formula means the division of the money left and your total amount, and all of that multiplied by 100. The higher the net profits means the more profitable the company is. The gross profit margin is a financial metric that indicates the percentage of revenue that exceeds the cost of goods sold. It measures how efficient the company is with the relation of sales and productions. The formula is gross profit divided by revenue and all of that multiplied by 100. The higher the gross profits means the better production related to the sales the company has. The operating margin is a financial metric that measures the proportion of a paying company's revenue that remains after paying for variable costs of production. It provides information of how well the companies control expenses for a better use of money. The formula is operating income plus 100 divided by revenue. The higher the operating margin, the more profitable and effective